Welcome, everyone. I'm Tim Kenny. I'm going to get started. This is part of our monthly best practice series. Today, we've got a very timely topic, understanding your business and personal taxes and paying them as well. So with that, we'll get rolling. Legal disclaimer, we're preparing this information to help you. We just ask that you let us know if you want to use any of the content. Everything is being recorded and we post all those recordings shortly after the webinar. So if you missed something or you want to share the webinar, feel free to forward the link, and appreciate you being here. A little bit about our firm. We like to think of ourselves as your partner without equity. We help business owners build businesses and their net worth to support their fulfilling lives. We've got clients at all stages, startup to ones that are exiting. Worthwhile plans take time to realize, and we work together with our clients to create plans that fit them. So this is a picture of your partner, your tax partner. So I included this so that just for a little humor, but then also to kind of remind you that as you have income events or there's changes, think about how that affects your taxes. Today's agenda, we're going to look at who needs to file returns, what the different types of income are, what's included in your total income, look at Social Security and the new senior deduction, what adjusts your taxable income, the difference between marginal and effective tax rates, what ordinary and active tax rates are, what the passive income tax rates are, and then the 2026 IRS landscape and working with the IRS in Illinois. Then have some time for some Q&A at the end. So I'm going to move quickly. Again, the recording will be available shortly after this. Who needs to file? If your gross income is essentially over the standard deduction, that would trigger a filing requirement. If you're self-employed and your net earnings, so that's your revenue less your expenses, exceeds $400, that would trigger a filing requirement. If you have dependents that have unearned income in excess of $1,350 or earned income exceeding the standard, that would require filing. Or if you have special types of taxes like alternative minimum tax, additional tax on IRAs and retirement accounts, if you have household employees, and if you have repayment of advanced premium tax credits or other credits, those would all be filing triggering events. This is an important slide. The different types of income really can be broken down into active income and passive income. Active income, this is income that you earn from your work on a regular basis, and the tax that you're subject to for this income includes Social Security and Medicare. Think your W-2, or if you're a sole proprietor or partner, the self-employment tax in that case, federal income tax, state income tax. And if you're active in, say, a business that normally would allow for capital gain treatment on that income, and you're active in that business. So let's take the example of a real estate developer. So the real estate developer is active in the real estate business, and if they're developing a property, that would make that income subject to ordinary tax rates, not capital gains tax rates. And so good segue over to passive income. That would be income earned from investments, carrying over our real estate example. If you're buying a piece of property, not improving it, later selling it, that would be passive income. You don't need to work to create this income, and market influences the rate of return. It's not subject to Social Security, Medicare, self-employment tax. There might be some income tax, ordinary income tax in the way of if there's interest income and state income tax, that generally is the same whether it's active or passive. And when you sell an investment, it's generally subject to capital gains tax. So what's included in the income, in your total income? You're probably familiar with this form. This hasn't changed for a while. Starting out with your wages from W-2s, employment. This is where the household employees come in, and then your investment income, qualified dividends, those carry capital gain treatment. Interest is subject to ordinary tax rates. Pension and retirement income in states like Illinois is not taxable. And then Social Security benefits, depending on your income, have some taxability. All of this generates your total income number. Speaking of Social Security, I added this slide because I think there's some confusion. Social Security taxability has not changed. It's the same as it was last year. However, there is a new senior deduction, and depending on your provisional income, which is your modified adjusted gross income plus tax exempt interest and 50% of your benefits, you would apply this to determine if 50% of your Social Security is taxed or 85% is taxed. This is nice for folks that are over 65. There's an extra $6,000 deduction. For a married couple, that would be 12. So that's a nice bonus. So if you're 65 and older, in some respects, most likely your taxes have gone down because of this senior deduction, but there is no change to the taxability of Social Security. Moving on down the 1040 form, page 1 and 2, can see that there's that total income line, line number 9. Then there's adjustments. You've got, if you're itemizing, that comes into play, or taking the standard. Those are all adjustments to come up with your taxable income. So you've got total income, adjusted gross income, and then taxable income. Looking at how this shakes out and your marginal and effective tax rates, This is a tax summary from our software, and it's a nice view of what's in a particular return. You can see some of those lines that come in summary total. There's our total income. In this example, 265,250. And there's an adjustment for self-employed health insurance. So in this example, the business or the taxpayer owns a business and they own more than 2%. And so their health insurance, in order for it to be deductible, needs to get added to their W-2. But then there's an adjustment for those premiums to come up with adjusted gross income. Then you're looking at itemized deductions or standard. And essentially you're taking the higher of the two. This example was from 2024. So the standard is a little different than it is in 2025, but you get the idea. So in this case, the itemized deductions were higher than the standard. So that is subtracted from the AGI, or adjusted gross income, to come up with the taxable income. And then the tax tables are applied and the tax is calculated. And then we're looking at all the payments. So there was 23,000 of federal income tax withholding, no estimated tax payments, so a balance due of 16,641. The marginal tax rate is 24%, but the effective tax rate is only 18.2%. And this is calculated by taking the total tax of 39,151 and dividing that by the taxable income, which is this line, 215,250. Now, a lot of taxpayers like to look at it based on what percent of each dollar of revenue is actually going to taxes. And so in this case, it's not the 18.2% or 18 cents on the dollar. You would take your total taxes and divide it by the total income, and you'd end up with just under 15%. So if you were trying to describe for every dollar of, say, W-2 wage income, what portion is subject to federal income tax, it would be actually 15 cents and not 18 cents. So looking at the tax tables, and these are the tax tables for active or ordinary income. The more you make, the more you pay. So in our case, our taxable income was in this band right here. And that's why our marginal rate was 24%. So our example, our taxpayer could have made up to 394,600 before they jumped up into the next marginal tax bracket, which is 32%. So if you want a fun tax exercise, calculate these for yourself. So again, you're looking at what your effective tax rate is, what your marginal tax rate is, and then what percent of every dollar of total income is actually your federal tax. For Illinoisans, it's real simple. It's 5%. So 5% of your income or taxable income is your Illinois tax. So that one is easy. However, with the federal, it's a very useful and productive exercise to kind of run these numbers for yourself, just so you know. And I can tell you, after practicing for more than 30 years, that I can count on one hand the number of times that clients that hadn't calculated this actually knew what they were paying for every dollar of income they made. So very worthwhile exercise. Now moving on to the passive rates. So there's two main passive rates. Most of us think about the long-term capital gain rate. Now, short-term capital gains are subject to those ordinary rates that we just got done reviewing. But if an investment is held for more than a year, it qualifies for long-term capital gain rates, which can be as low as 0%. And then it jumps up to 15% and then 20%. Just like with the marginal rates, the more you make, the more you pay. Let's just look at a single filer. So up to 48,350 of income, the rate is 0, and that's all their income, including the capital gains. And then over that, they would be in the 15% band, and then over 533,400, they jump into the 20%. On the right side, this is something that you may or may not be aware of, but after 200,000 for singles and head of households, you're subject to an extra tax called the net investment income tax. And so again, if your income is over 200,000 or 250 or 125, married filing separate, and you have passive income or investment income, this is an extra tax that comes into play that increases your overall or effective tax rate. So a little bit about the landscape of the IRS currently. They're understaffed. If you've tried to contact the IRS on the phone, you would know that. But hopefully you haven't had to do that. This is a report from government executive that I had in a newsletter that I wanted to share. But essentially, out of the authorized new workers, only 2% have actually been put in the field. So that creates a big gap as far as agents to actually speak with. So keeping that in mind, we've got an approach that we really aren't changing to respond to that because we don't have to. It complements the lower staffing on the IRS front in that we're filing almost every one of our client returns electronically, and we're deploying a really strong review process with multiple reviews so that we get it right the first time. And on the tax payment front, especially in this day and age of fraud and scamming, makes sense to make the tax payments on the IRS website or Illinois website. Be careful of spoofing websites when you're doing this. And if you haven't made a tax payment electronically, there is a resource available on our website. Let's just see if I can kind of pull that up. So we've got a separate page on making federal and state tax payments that I think is very useful. it's also a good idea to create your own IRSID.me account. And there's instructions and short videos on how to do that. And then one thing that I just noticed, if you own a business, the IRS has posted a video about how to set up a tax account. And so it's a real short video. Essentially, when you're able to tap into the IRS's data, pull a transcript for which is actually an account summary. So if you were speaking to an agent at the IRS, which there's fewer of those available for you to talk to, they would be looking at exactly what you're able to access with a business account or a personal account. And that's why it's so valuable to put those into place. The IRS makes it reasonably easy to do that. So let me get back into my screen. So we've got a little time for Q&A. And I'm gonna
Hey, Tim.
open it up. Yes.
I just wanted to make note that the IRS is sending, if they don't want any checks, they don't want to send paper checks either. So if you're not using direct deposit and for any refunds, they'll hold the refund. You'll get a notice in the mail that says, hey, give us your direct deposit information. You respond to the notice. At that point, then they will direct deposit it. So you're better off the get-go using direct deposit. Otherwise, it's just going to hold up the process. I did see out on some of the groups that I belong to that, which hopefully isn't the case, if you credit an overpayment, you are getting the same notice that says, hey, where's your direct deposit information, even though you're crediting the overpayment, which could potentially cause some major confusion. So just food for thought. Direct deposit when you can, make online payments when you can.
Yeah, great point, Joanne. So the direct deposit of your refunds, that's a great suggestion. Anyone have, we covered a lot quickly. That's, we don't want to eat up your entire lunch hour, but any other questions on anything we covered? Or if there's something that I didn't cover that you have a question about, be happy to try and get you an answer right now as well. All right. Well, thank you for joining us. I'm going to give you an extra 5 minutes back for your lunch, and look forward to seeing you next month. Thank you.